Are home prices rising or falling? This is perhaps the most debated question in real estate, and the answer depends on multiple factors, including sector, location, and more. In this video, we'll remove all the hype and provide a data driven explanation about exactly what's going on in the US housing market. We'll also provide a few insights as to whether now is a good time to buy a house and where you might find the best deals. To start, we have to separate the US housing market into two categories: newly constructed homes and existing homes. New homes are about 15% of total sales volume on average, with existing homes making up the remaining 85%. But the dynamics in the new home market are far more important than the 15% figure suggests. The average price of an existing home has increased to an all-time high on a national basis, currently sitting at roughly $562,000. The average price of a newly constructed home, however, peaked in late 2022 and has decreased to roughly $512,000. As the chart shows, it's not common for an existing home to be more expensive than a new home. Let's now wind the clock back to late 2021 and early 2022. The Federal Reserve started to embark on a monetary tightening to reverse the excess money creation and deeply negative real interest rates that existed in 2020 and 2021. Real M4, the broadest measure of money supply graphed on the left, started to decline in early 2022 and has now almost retraced back to the pre-pandemic trendline. Real interest rates, graphed inversely in this chart, started to increase from negative 6% to nearly positive 2%. This tightening of monetary policy caused a significant trend change and cooling of the housing market. The problem, and why the Federal Reserve has not been as successful in reducing home prices as the pace of monetary tightening may have suggested, is because there is very low supply in the overall US single-family housing market. This chart shows the month supply of total US single-family housing. The month supply measures how many months of inventory are in the market for a given pace of sales volume. A balanced market with no upward or downward price pressure is roughly 6.0, and you can see the US single-family housing market has been below this 6.0 level since 2013. At the worst of the US housing supply crisis, the month supply of US housing hit 2.0, the lowest level ever. It has now increased a bit, but if we were going to make a generalization about the total US housing market, low supply is certainly accurate. However, there is much more nuance to this, which is why we began this video with the split between new homes and existing homes. The supply situation in the US housing market is completely different in the new home market compared to the existing home market. For the existing home market, there is very low supply, with a month supply of just 3.2. However, for new construction, there is a huge amount of supply, with a month supply of 8.3, holding above the balanced level of 6.0 for 2 consecutive years. This major difference in supply is one of the key reasons why we are seeing a divergence in home prices, with existing homes rising to new all-time highs, but newly constructed homes having average prices peak a year and a half ago. In fact, today the average new home is more than $60,000 cheaper than the average existing home, the largest spread on record. The chart on the left shows the spread between the average new home price and the average existing home price, and you can see that new home prices are $68,000 cheaper. Now, a lot of people will be quick to say that this decline in new home prices is only because home builders are building smaller homes. While this is true, it does not account for the entire difference. Home builders started building smaller homes in 2015, with the average square footage of a new housing start declining from over 2,700 to under 2,400. So we've seen about an 11% change in the size of the average housing construction start since 2015. These two charts show the median size of a new housing start and the median sales price of a new housing sale. While it's not a perfect science, we can use the ratio of these two data points to get an approximation of the median sales price of a new home adjusted by square footage. At the peak, the median sales price of a new home was about $217 per square foot, and today that has declined to about $196. This translates to a 10% decline in the median sales price of a newly constructed home after accounting for the change in size. Of course, there was an enormous increase in prices from 2019 to 2021, but this is to combat the narrative that new home prices are not declining after accounting for size. They certainly are. Some of the decline in new home prices is due to size, but the big factor is, of course, supply. When the month supply is above 6.0, that puts downward price pressure on the market, and the new home market has had elevated supply for over 2 years. This means that home builders have had to reduce prices in order to keep building more units, or else their supply figures would continue rising. So we have a bifurcated housing market with existing home prices reaching new all time highs in most cities with very low supply, while new construction prices are declining due to smaller home sizes, but mostly due to high supply. Let's now move on to home price valuations and see if it's a good time to buy a home and what type of home. The best and most mean reverting valuation metric for housing is the home price to income ratio. For new construction, on average, new homes have traded for 8.1 times disposable income per capita. In the pandemic, this ratio surged to over 9.5 times, the highest ratio ever, before falling to nearly average at 8.3 today. For existing homes, the picture is quite different. On average, existing homes traded at 7.7 times disposable income per capita. The home price to income ratio for existing homes reached 10x in 2021, matching the 2007 bubble, and have since come down a touch to 9.1. But existing home valuations are still miles above average, while new home prices are closer to fairly valued. If we normalize each metric against its respective long run average, we can see that in 2007, existing home prices were in a huge bubble, trading at valuations 30% higher than average. Today, existing homes are trading at 18.5% higher than average valuations, while new homes are about fairly valued, but this huge gap is very unique, and it has to do with the supply dynamics outlined. These charts show the change in home prices for existing homes only. All major metro areas are up massively since 2020, with Miami up a staggering 75%. Since the tightening cycle started in 2022, existing home prices have declined in 7 out of 20 major cities, or if we extrapolate, about 35% of regions around the country. The regions that have showed declines in prices over the past 18 months are regions that either have unique political problems or have a high volume of new construction, which is dragging down the price of existing homes. Places like Chicago, Miami, and New York have almost zero new construction, while Las Vegas and Phoenix are well known for boom-bust construction cycles. This plot shows the dynamics in the existing home market in a slightly different way. On the left-hand axis, we're measuring the percentage decline in prices, and on the bottom axis, we're measuring how many months it has been since a new high has been made. Most cities are pegged in the upper left corner, which means they are currently at all-time highs, while 7 cities haven't made a new high in existing home prices in 19 months or more. So what's happening in the US housing market is that the Federal Reserve started to tighten monetary policy in 2022, and this led to a rapid slowdown in housing demand. There is very low supply in the existing home market, so prices haven't declined as a result of this reduced demand. but home builders have continued to build. This led to an increase in supply for the new construction market. Home builders want to keep building, so they've had to start building smaller homes and cutting prices to prevent a glut from forming. New homes are now roughly fairly valued relative to income, but existing homes are still very overvalued. The problem is that new homes are only about 15% of the market, so not all home buyers have access to this more affordable market. In select cities where there is a lot of new construction, we've seen a bleed through to the existing market with price declines and no new all time highs in almost 2 years. If the Federal Reserve keeps their foot on the brake by reducing their balance sheet and holding positive real interest rates, we will see further declines in the new construction market, which will eventually force home builders to stop building. And this will lead to an increase in the unemployment rate, and only then will we start to see an overpowering of the low supply situation in the existing home market, the market that most people interact with.